Hi guys, and welcome back to FutureFunded. Today I'm going to be going through a sniper entry model and how to actually break it down so you know when to enter, when not to enter, when you're entering too early or when you're leaving it too late. I'm going to give you the exact methodology that I've been using for years that has allowed me to pass my accounts with FutureFunded on both FX and futures. So let's jump into it.
So let's just get straight into it, all right? So first and foremost, you have to be able to understand liquidity. That's one of the most important things in any market. I don't care if you trade FX, futures, commodities, whatever, right? You have to understand where there is a buildup of retail traders in the market and where price is likely to go next. That doesn't mean that you're always going to get it right, but what it does mean is that if you have an indication of what might be happening next, or if you can create a narrative, let's just say, of where you believe price is going to go next, and you build that bias based upon that, you have a much more solid foundation and more confidence with your conviction, especially when it comes to entering. So let's just start based upon what we see right here. All right, so on the hourly time frame, we can see that we are stepping up bullish. We've got highs, high lows, a new high, and a potential higher low forming. Okay, now the reality of the situation is you could look at this and you could say, yeah, okay, there's an hourly point of interest right there, which price might tap into right here and then start to reject and move up. That's what most traders would look for, but we're not in the business of looking at what most traders will do. We are in the business of figuring out what most traders do, and then we do the opposite. All right, we can't go in line with retail methodology, because if we do that, we just become liquidity. We don't want to be doing that. All right, because then we get heavily manipulated. So we can understand, first of all, prices come into this 1 hour point of interest. We're at the lows of Asia low. All right, so what is the first thing that most people are going to be thinking of doing? The first thing they're going to be thinking, bullish market structure, we're at Asia low, wait for a liquidity grab and then go long. All right, okay, fair enough, you can do that, that's no problem. But how many people are doing the opposite? How many people are thinking, okay, well, hang on a second. If we have a look at this based upon what it actually is, we can see that where we're coming from, a downtrend. All right, so market structure, yes, okay, we're in a bullish range internally, but current momentum is to the downside. All right, so if I just get rid of that for a second, where's the liquidity? Well, there's liquidity down here, and there is also a 1 hour low down here. At some point, price is more than likely going to want to take that out. Why? Because really, a break of structure low or a 4 hour, 1 hour high, these are all just areas of liquidity, areas where retail traders have their stop losses. Okay, so what did I mention at the start? Price is more than likely going to want to go to these areas and take out more liquidity. Okay, so if we have that in mind, we can say, all right, if we go onto the 5 minute, we can see that we got pushed to the downside. We can see that Asia low, gets manipulated and taken out. No problem. We have a 5 minute marked up right here. We can see that price has come back up, swept that, done a small retracement, and now moved higher. But the thinking in my head was, well, if most people are going to be looking for longs here, I know that there is liquidity and a break of structural low at just down here, basically. So if I know that, and if I can keep that in mind and follow the market direction of what I believe will likely happen next, in my head, I was thinking there is probably a higher probability that price is probably going to want to take out those lows, or at least one of the lows, whether that's the liquidity itself or this break of structure or the 1 hour low, sorry. All right, so having that in mind and knowing the fact that we are at Asia lows already, and you've seen for yourself how often Asia low and Asia high does get manipulated in many different forms now. All right, it's not as simple as just buy and sell from there anymore. Now you have to be very, very cautious with how you actually look at trades. So now it was just about, okay, let's wait and see what price does when we get to this break of structure high. So we had an initial rejection, price then comes back up, but the reality is, why did it come back up? Why didn't it just sell off down to the lows from that point? Well, we have liquidity right here. That's the first problem. Then we have liquidity right here, and we also have liquidity right here. And then above that, we have an imbalance or fair value gap, whatever you want to call it. Okay, so we've got 3 areas of liquidity that price ideally needs to take out. And what do we say? Price always wants to take out liquidity at some point. Okay, so if we know that, we can then very simply wait until price has taken out these areas where retail traders have their stops and tap into a fair value gap. All right, hence why I wasn't looking for a short here down to that low, and hence why I wasn't looking for a short here down to this low. All right, because I knew there was still liquidity that needed to get taken, and I would have taken losses. The moment that liquidity did get taken though, here, here, and here, from this price action was the moment that I started to think to myself, okay, now I can get serious with this. Now I can really focus on an actual entry. Now, the first thing you always have to look for, I always look for, is I want to see sellers come into the market to begin with. And that's what we get here. We get this selling candle on the 1 minute time frame. All right. And just before that, we get what? A buildup of liquidity, equal highs right there. So there's my first confluence. Second confluence is this selling candle. My third confluence is actually a sweep of this high. Do you see how we got the selling candle? Immediately we then get a sweep of that. And then my fourth confluence is then seeing two selling candles come into the market. That shows me that sellers are now taking over, and we've swept all of the liquidity within this range that we can do before price leaves. And the moment that I got these two momentum candles, these large candles pushing to the downside, I didn't want to enter at the low. I wanted to see a bit more of retracement, simply just because I wanted a better entry, and I got it. All right, I got an immediate 1 minute candle, a bullish candle pushing back to the upside. I then got a 3 pip stop loss, and now I can go. Now, ultimately, what do I always say? It's one thing being able to execute, it's another thing being able to manage your trade correctly. All right, ultimately, I was looking for this low to get taken out. Why? Because I knew that there was liquidity sat right there, all right, in the form of equal lows. So that was my ultimate target. But I also knew that there was equal lows right here, and there was also equal lows right here, or relative equal lows, okay? But in my head, I was thinking, well, this is too close for the move, so I'm happy to ignore this and still allow the trade to play out on full risk. But once price gets to this area of liquidity, this is when I'm going to really start to manage it properly and move my stop to break even. So as soon as we got here, I was at break even, and I took 80% of the trade off to allow 20% to see if we can get to the ultimate TP. We didn't eventually get there. We actually ended up back at break even, but I still managed to take 2.8 to 3% out of the market. That's the most crucial thing here. So you have to understand, where am I taking profits? If you are not taking partial profit, sorry, I can't help you. All right, it's as simple as that. I can't help you, because you're not thinking about risk. You're then thinking about the outcome. You're thinking about how you can get the ultimate home run without at least accepting, or at least being prepared to look at the downside. The downside is we don't know how far price is going to go. Okay, price could have easily just tapped into this area of liquidity and shot back up and then gone straight to stop. It could have easily done that. All right, so you have to manage the trade as if you don't know what's going to happen next. So what does that mean? It means that you have to focus on the areas where there is a higher probable chance that price is going to reverse on you. And I keep saying it, and I will keep saying it. Liquidity is the #1 area where price is likely to not only tap into, not only manipulate, not only sweep, but then also reverse as well. All right, and you can call that support, resistance, whatever you want to call it. I don't use support and resistance when I enter my trades. It's not part of my strategy, but what it is definitely a part of is where my targets are. All right, because yes, I want to sell into that liquidity, because that's where I believe price is going to go and tap into. All right, so focus solely on how you manage your trade. Focus on how you can extract as much profits out of the market, but still being risk averse. All right, don't focus all of your attention on just keeping the trade wide open, stop loss, TP, not taking partials, being reckless, because ultimately, guys, all that's going to do is just lead to emotions. All right, when it comes to psychology and stuff like that, people always bang on about it, but the reality of the situation is you don't help yourself, because you could control your emotions far better if you just took partial profits. But you don't want to do that because you want home runs. So if you want home runs, then don't expect or don't be surprised when you can't control your greed, or you can't control how you're reacting to price movement, or the fact that you're getting anxiety or nervousness and all these kind of stuff that comes with it. I don't get any of this, not because I'm immune to it, but simply because I manage my trade correctly. So I don't have to feel any of these emotions, because I understand that if I just take partials here, 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 then I'm always paying myself throughout the trades I've already won. So even if the trade reverses like it has done and comes back to my break even, I've managed to turn this into a winning trade. Okay, so that's one of the most important elements. All right, and then of course the actual entry itself, the entry is crucial. We don't want to enter too early. You never want to enter at equal high or equal low. So I would never look for entries here. Plus we've got liquidity here and here just above. But once the liquidity gets taken out, if we then get a first test followed by a last sweep, which I would class as a second test, followed by selling momentum candles or buying momentum candles if it's a long, then you can start looking at, how do I get into this trade now? It's hit everything I need to. Don't rush it. Just find an area where it meets your requirements, where you can get in. All right, and if you end up missing the trade, you end up missing the trade. There's going to be a million other trades. That's another crucial thing. If it plays out, but it goes off without you, that's fine. But that is okay. This isn't the last trade you're ever going to take. You have to look at it like that. Look at it like a business. Yes, it's an opportunity, but at the end of the day, you know, with trading, you're always going to get opportunities. With business and life, yes, okay, you can miss an opportunity and you might regret it forever. But the reality is, if you take a trade, or if you miss a trade, let's say, and you class that as a missed opportunity, you won't even remember this setup in a month. Do you see what I'm trying to say? You won't remember it, because you'll look at the end of the month and you'll be like, okay, I made, I don't know, 6%, 8%, 10%, 15%. Are you realistically going to remember this missed setup? No, you're not. So if you're not going to remember it in a month's time, don't give it power now. All right. Don't allow yourself to get drawn into this trade out of the fear of missing it. The fear of missing out is a huge thing in trading, but you just have to think of it like a business. Think of it over the long term. You are not going to remember this trade probably even in a week, let alone a month. And you're certainly not going to remember it at the end of the year when you're doing your end of year or year-to-date results. All right, so I hope that helps, guys. All right, so let me know what you think in the comments. Let me know if you have any questions and this, that, and the other, and we can answer them. But until then, I will see you next time.
So there you have it, guys. That is the exact entry model that I used. It's very specific, it's very calculated, but you have to find something that suits yourself. Not every entry model is going to be suited to you. You have to find something that suits your routine, that suits you as a characteristic, and most importantly, that you feel comfortable with. Otherwise, what's the point of doing it in the first place? So as always, make sure to go over to FutureFunded, get your challenge, check out the educational bits on their website, see for yourself, and I'll see you inside.